I'm here with Shane Clark, President of Euro-American Financial Advisors, a specialist provider of financial planning and investment advisory services for Americans moving to or living in the EU. In this video, we're going to discuss how to invest as an American living in the EU. So, what investment challenges are unique for Americans living in the EU?
Well, when you think about being an expat, many people can be expats from many different countries. If you're an expat from the US, it's unique. The reason why, primarily, is the US is one of two countries that has citizenship-based taxation. And what that means is you're always going to have to pay taxes in the US if you've got that blue passport. So once you become a tax resident abroad, you're going to pay taxes in your country of residency. You're going to file a return in the US to let them know you're paying abroad. And there's two different ways you can offset having to pay in both countries. One of them is the foreign tax credit. The other one is the foreign earned income exclusion. And that means you're probably only going to pay taxes in one country in the EU. And then another issue is banking. So who's going to work with you? If you're in Germany, for example, German banks probably aren't going to want to work with you because of FATCA, the Foreign Account Tax Compliance Act. As a US citizen, there's an additional amount of paperwork all these institutions need to collect and report to the US institutions about you. And a lot of them is such a small number of clients, they don't want to do it. What about in the US? Your US banks might not want to work with you either. So now you're left in a situation where it's really hard to find a banking partner. Luckily, there are some modern solutions. Companies like Wise, Revolut, some of these digital online banks can offer you accounts as a US citizen. And then where can you invest and in what? So oftentimes you don't want to buy foreign mutual funds or foreign exchange traded funds. And what we mean by that is any local fund. So you go into a bank, private banker tells you, oh yeah, we've got some solutions, buy these UCIT funds. Those are going to be called PFICs. You want to avoid those. You can't buy US mutual funds because they're not regulated where they're distributed in the EU. And oftentimes, as a retail investor, you can't buy US exchange traded funds.
So how do US tax rules affect investment choices for Americans resident in the EU?
Yeah, this one brings up kind of the who, what, where, when, how, right? So the first question is, where can you invest? And that means in which institutions. So if you've got a broker in the US who's expat friendly, like Charles Schwab or Interactive Brokers, they can custody your accounts in the US. And Interactive Brokers actually has a solution in Ireland. So if you have a taxable account, you have an address in the EU, they're going to hold that account in Ireland and you can invest in them. And then what can you buy? Maybe coming from the US, you're used to having things like mutual funds, exchange traded funds, individual stocks, bonds. Once you leave the US, you can't have mutual funds anymore. As a retail client, meaning you open the account yourself, you can't buy US ETFs. So that's complicated. What are you left with, right? Individual stocks, individual bonds. And then who you can work with depends on if it's a local institution that accepts US people. Another thing to tuck away is US tax reporting. So if you work with a local bank, are they going to have US 1099 tax reporting? And then how are you going to be able to get these reports to your US CPA to file at the end of the year?
So how should Americans diversify their portfolios once they're living in Europe?
That's a good question, and it's complicated. So we've just discussed, what you can buy becomes quite limited once you move abroad. So we always recommend, let's take a step back. Let's look at your overall picture. How much money do you need? What level of risk do you need to take? And these types of questions, we kind of firm up using our financial planning. So we get a better idea about what you want and what you need. And then we can help you build a better investment portfolio. But really, it's about diversification. So in the US, a lot of brokers, a lot of advisors focus on the US markets. It's the biggest market in the world. There's lots of great opportunities there. But moving abroad, we like to diversify the portfolios more. For example, right now, our portfolio global asset allocation is around 50% exposure to the US 50% to the rest of the world. And then how we manage currency risk, there's two different ways. You can indirectly manage it by holding US exchange traded funds that hold European assets in a broker like Charles Schwab. The other way is directly, where we use interactive brokers. We go in, we trade on the European exchanges, and we buy compliant investment products. And I mean individual stocks, individual bonds.
What are the risks of investing in EU domiciled funds as a US citizen?
The major risk is taxation, punitive taxation. So, US institutions, they don't want your money outside the US. So they design these laws to hopefully incentivize you to keep your money in the US. And what these foreign investments are called are passive foreign investment corporations, or PFICs. And there's a lot of problems with them. The main one is you're going to be paying every year in the US, sometimes on unrealized capital gains in these accounts. And your accountant, I've heard that it can take 40 hours to fill out the paperwork required for the reporting in the US for one fund. So if you've got a dozen funds, you're going to be paying your CPA handsomely. The second issue is the costs. So oftentimes when I speak with prospects, they say, well, I want to invest in Europe, so I bought these local funds. The US, as flawed as it is, has a very efficient financial system. And in the 1980s, 1990s, we saw a lot of increased competition, which brought prices down. So for example, if you want to buy an S&P 500 exchange traded fund, that might cost you 0.05% for a management fee. If you want to buy that same type of fund in Europe, it might cost 3% a year. So the costs are usually very poor in terms of management fees, and then you're going to pay more in taxes. It's best avoided.
How can Americans balance compliance and performance in their portfolios?
Well, we always say, being licensed in the EU, I've learned a thing or two about compliance the past few years, and compliance is paramount. So that has to be the foundation, is making sure that you're compliant. If you make a mistake with your compliance, it's always going to cost you more. So if you're chasing, paying less in taxes at the expense of compliance, you're going to be in for a bad surprise. So we always say, speak with a local tax advisor, speak with a U.S. tax advisor, speak with us, and we'll make sure that we set you up in a portfolio that is compliant and isn't going to create a problem in either jurisdiction. Here's why. Something I see is people will chase tax efficiency in their country of residence. So they'll speak with a local tax advisor who will say, all of my European clients do this. And they probably do, and it works wonderfully. The problem is on the U.S. side then. So if it doesn't sync in both jurisdictions, you're not doing yourself any favors. The other issue I always say is, something that is fun, sexy, is an exotic investment. Something like a local hedge fund or, a unit-linked insurance bond, something like that. Again, if it's efficient in your country of residence, but it creates huge problems in the US, you're going to end up paying much more than you saved in taxes in that country. So you want to have a holistic view of that whole situation before you jump into it. And then the other thing is fees. If you're investing in a hedge fund, you're losing liquidity. You might not be able to pull money out of that fund for 10 years. It might claim it's going to have good performance, but losing liquidity is important. And the other issue is the fees. So oftentimes, if you work with a fiduciary advisor like our sister firm in the US, the fee structure is very transparent. Oftentimes in private equity and hedge funds, it's not transparent at all. And you might find that you're paying 6 to 9% a year in fees. And even if the performance is an additional 4%, the juice isn't worth the squeeze.
What role should US-based investments play in an expat's portfolio?
I think US investments are always going to be the core. So that's always going to be, the meat and potatoes, if you will, of your portfolio. We have really, really strong information technology companies in the US, biotech companies. S&P 500 in general is quite a strong market, and we often see a lot of growth there. So that always has to be a part of your portfolio. So maybe you're thinking, I'm leaving the US, I'm going to take all my money out of the US. We advise against that. You need to keep some money there. We've got strong growth potential in the future as well. And then what about currencies? So wherever you invest, you're still going to be tied to that currency. And the US dollar continues to be the reserve currency of the world. All of the oil markets trade through the US dollar. So you need to have exposure to the US dollar. And then something we're seeing right now, which I recently did some research on, it's quite interesting, is whenever the market has a downturn, it's negatively correlated to the US dollar. So in 2008, when we saw the financial crisis, the markets went down almost 50%. We saw the US dollar strengthen relative to its peers, not as proportionally, but pretty significantly. So that's another hedge against market downturns, is the US dollar.
So Shane, how should currency exposure be managed as part of an investment strategy?
That's a great question. I think we should take a step back first. So if you're living in the US your whole life, all of your expenses, all of your revenue are in the same currency, US dollars. Now, if you move abroad, you might have all of your investments in one currency, and now all of your expenses in a new currency, euros. So that's where the problem lies, is your revenues and your expenses don't match. And let's say, for example, the euro appreciates relative to the US dollar 10% in a year. What that means to you is if all your money's in US dollars, you just lost 10% of your purchasing power. And 10% might not seem like a lot, but when you start thinking about, maybe you pay 0.5% more in advisor fees. Maybe you pay, 0.5% more on a currency transfer. Those types of expenses tend to upset people. But losing 10%, that's a huge number. That's something we need to mitigate. So there's two ways to do that. There's indirectly, where you hold US exchange traded funds that hold European assets. That way, if those European assets were to appreciate with the currency 10%, the price of the ETF goes up 10%. That's indirect currency management. Direct currency management is if we were to go in and trade using our sister firm on the European exchanges. So a broker like Interactive Brokers is a multi-currency broker. So we can go in, trade on the European exchanges, hold individual assets that are denominated in euros. And that way you've got a portfolio of individual stocks, individual bonds. Now what's interesting is on the equity side, we have two different sleeves, if you will. One of them is a growth sleeve. One of them is a value sleeve. And in Europe, just like in the US, tech companies are quite famous internationally. Some of these value companies in Europe are quite well known as well. Orange, BNP Paribas, a lot of the financial institutions, Budweiser, InBev is a big one. They produce a nice dividend yield. It could be between 5 and 9% per year. So those are two ways to manage currency risk.
So what are some common portfolio mistakes Americans in Europe make?
Let's think about it this way, Hugo. You're from the UK. If you were to move to Portugal, would you want to invest your entire life savings in the Portuguese economy? Probably not. So that's what we call overexposure. That's when you're overly exposed to your country of residence. And sometimes people think that's a good idea because coming from the US, we have a huge investment market. So your whole exposure might be in some cases to the US market. So you keep that mentality when you move abroad. But in Portugal, the market, the companies, the revenue, the GDP, it's much smaller. So you don't want to continue with that same mindset. Another issue, PFICs, passive foreign investment corporations. These are something you want to avoid because they're taxed very punitively by the IRS. Don't buy PFICs. And the last one is tax wrappers. So what is a tax wrapper? Well, there's many different forms. One of them is a unit-link insurance trust. And what I've heard many times from local tax advisors who might be used to advising non-American clients is to invest in these tax wrappers. Now, what they are is similar to an annuity in some senses. One is limited liquidity. So you might invest in it and you can't take money out for 10 years. Another problem is the fees. The fees, internal fees for the products, the fund management, the investment advice, the custody, it might be between 6 and 9% per year. So if you're not paying capital gains taxes, or in some cases a wealth tax, but your performance isn't outpacing the fees, essentially you're just losing money slowly.